Hi, my name is Jennifer Hansen, and I'll be presenting Becoming Your Own Banker today. You know, families and businesses are all too often giving up profits to banks and finance companies, and we're going to show you how to change that. We'll focus on turning liabilities into assets in this presentation, and we're going to do that by showing you how to use financing as a wealth creation strategy. You know, most Americans borrow because they have to, but wealth creators borrow because they want to. The way you and I finance our lives always impacts our wealth, for better or for worse. It just does. The first principle to increasing our wealth is to understand the power of our cash flow. Everything, and I mean everything we buy, involves financing. We either borrow money and pay interest to someone else to use their money, or we pay cash, draining our savings and giving up the ability to earn interest on that money for the rest of our lives. Lost opportunity cost is what that's called. Every financial decision we make impacts every other financial decision because they're all tied together. So let's compare two ways to finance a car using cousin A and cousin B, who are going to purchase the exact same car. But before they do that, they're going to attend seminars on wealth creation. Cousin A's seminar is all about using the government-promoted, qualified, Internal Revenue Code plans in the 400 series. He selects a 401k because it had the longest line. He was also enticed by the immediate tax deduction, his company's match, and the fact that it allowed his money to grow tax-deferred. Now, I have a question for you. Who is opening his chest of money on the bottom right? Well, it's his partner, the IRS. They don't invest any money and they don't take any risk, yet every April 15th, they're going to check how their money is growing too. Cousin B's seminar was different. It emphasized liquidity, so he had the use of his money and the control of his cash flow. He identifies ways to capture that money that is currently being lost unknowingly and unnecessarily. And he uses those funds to build additional wealth, properly using an Internal Revenue Code 7702, where his assets will grow tax advantaged. Now he's in a hurry to put his money someplace other than that chest, so if he wants to take his money out, penalty and tax free, he can do that without restriction. So let's get back to the two cousins. We're going to call cousin A a debt manager and cousin B an asset manager, simply because of the way they manage their money. They both go to the same slick car salesman, and as we mentioned, they're going to buy the same car for the same price, same interest rates, everything's the same. Now, cousin A, he has his money in the qualified plans, and he doesn't really want to deal with penalties and taxes and restrictions and all of that sort of stuff. So he goes to his corner bank and shows them that they ask him to check his credit because it's really good. He's always paid his bills on time and everything's going well. And so therefore the bank lends him the $10,000. Now they want to set up a monthly payment, structured monthly payment for $230 a month, which he pays on time every time. Cousin B, on the other hand, he has a monthly payment. He saves his money in the 7702, which he calls his family banking system. And so he borrows the $10,000 from there, and he also sets up a $230 a month payment plan. Both of the cousins at the end of 4 years have paid their 48 payments back to their respective banking systems, and both of them have a car that has depreciated. Now we're going to say it's depreciated to around $4,000. Now that number's kind of irrelevant because it's the concept that we're trying to get across here. So let's look at what's happened to that principal and interest, which ends up totaling about $11,040. Well, for cousin A, all of that money has gone down the black hole that we call the rat hole. And we call it a rat hole because that money is gone forever. He's never going to see that money again. Rat hole corner bank, same thing, same. The money does not get seen again by cousin A. Cousin B, on the other hand, he puts his money back into his family banking system, and if we add that to the 4,000 of his appreciated car, he has a grand total of $15,040 back in his control that's liquid for him to use again. It's no wonder he's jumping up and down on cloud nine. Cousin B, he's got a grand total of 4,000, and it's no wonder he's running over to that rat hole looking for the rest of his money, saying, where is it? The longer that we finance our lives the way cousin A is, the more that rat hole is going to consume our retirement. Now, we all know that money doesn't grow on trees, but trees have branches, and so do banks. And that rat hole consuming cousin A's money is what's helping to grow those corner banks. So when you finance your next car or vacation, business expansion or equipment or kids' education, you will either increase your net worth or decrease it. You can be a cousin A or a cousin B, because you have a choice. Which cousin do you want to be? If you'd like to learn more because you'd like to be a cousin B, the first step is to read best-selling author Nelson Nash's book, Becoming Your Own Banker. Thanks very much. Have a great day.